Qualified business income tax deduction is a free gift from the IRS to you, the business owner, that will help you save tens or even hundreds of thousands of dollars on your taxes. But unfortunately, I've seen it way too many times that business owners actually did not take this deduction. You don't have to do anything extra in your business to be able to take this deduction. It's really a matter of checking off the box on your tax return and filling out a proper form. And a lot of tax preparers who are just putting the right numbers in the right boxes, those tax accountants, miss this deduction for business owners, costing them tens or even hundreds of thousands of dollars in deductions and then in savings because this deduction was not taken on their tax return. So in this video, I will break down to you, first of all, what is a qualified business income tax deduction and how you can ensure that going forward from now on, if you did not take this deduction or you don't know whether that deduction was taken or it was not taken to the full extent, in this video, I will show you how to make sure that that never happens. Ready? Let's go. Hey, welcome to my whiteboard tax strategy. My name is Boris Mosheyev. I'm a CPA and a tax strategist. Every Tuesday, I release a tax strategy video for business owners like yourselves to help you save money on taxes. So please go ahead and hit the subscribe button, the bell notification button. Please like this video if you really like it, share it, and check out the description below for more resources that I've put together for business owners just like yourself. Now, let's get to my whiteboard for more tax strategy. Okay, awesome. Welcome to another whiteboard tax strategy here on YouTube. So like I said, today we're going to talk about qualified business income tax deduction. And as always, I'm going to stay in the frame for you, right? I am going to be breaking it down for you in 3 simple steps, right? First of all, we're going to talk about what is really qualified business income tax deduction, where to check on your tax return, who qualifies, who doesn't, and really how, a strategy actually behind it. We're going to talk about a strategy here, and I have for you a tax strategy, few tax strategies outlined. So going forward, this doesn't happen. Or if you are taking a qualified business income tax deduction, you may be losing it if you do not do certain strategy in your business because the income goes high or there's no payroll. Whatever it is, we're going to cover it all here, I promise. And the second thing, last thing, right? I have 2 case studies for you. Gary and Chris. Both of them have a business where they came to us, we reviewed their returns, and we found what they missed and how much they missed. As a matter of fact, Gary missed $428,000 in qualified business income tax deduction. We will make sure that this doesn't happen to you. Okay, now let's get started. What is a qualified business income tax deduction? First of all, you have to understand it's a 20% deduction. See, when the tax law was passed in 2018, Tax Cuts and Jobs Act, TIGJA, they gave a corporate, right? There was a corporate tax rate, a new tax rate, which was lowered to 21%. Everybody was going ballistic about it. It's like, wait, what about the small business owners? They said, okay, don't worry. For these small business owners, such as pass-through entities, S corporations, sole proprietorships, or partnerships, we'll just give them a 20% deduction. And the way it works, I'm going to keep it very, very simple, although it gets a little bit complicated when you have a lot of people on payroll or there is some assets owned by the business or what's not. But we're going to keep it simple. That applies to almost everybody. Okay. Now, what is how does 20% calculated? The way that it is calculated is simple. It's 20% of either lower off your business income or your taxable income. Assume your business income is $100,000, but your taxable income is $80,000. Now it's 20% of that $80,000, and bam, you get a $16,000 deduction. Just like that. All you have to do, or all is your accountant has to do, is check off the box. Now, that is the simple way to do it. And there's, of course, a lot of tax strategies involved. If you do not qualify for this deduction, which we're going to talk about in a second, what those tax strategies are. So stay with me till we get there. Now, like I said, that's the 20%. If you want to go ahead and check your return to see if you're getting this deduction, open your 1040 individual income tax return. It should be on line 13 of your individual income tax return. It would say qualified business income tax deduction, and there's also a form, I think 8995, where all of that goes on. But you should be able to see if that number is blank, If that number is blank, oh, somebody's getting in trouble, and that is your tax preparer. Now, we've got that out of the way. Now comes the tax law and says, hold on a second. Wait a second. If you are what's called a specified service trade or business, such as you're an attorney, or you deal with law, you're a medical professional, or you're an accountant, right? Or a consultant. Now, consultant is not, I'm not going to get into details of this in this video, but it doesn't mean that you're a consultant, you're considered a specified service trade or business. It's a very particular consultant, so I wouldn't worry. Most consultants do not fit into this definition. But if you are one of these, and there's some financial planners here as well, if you're one of these, you're considered what's called specified service trade or business, aka also known as, but not spoken of by the IRS, you make too much money. That's right. They're basically saying, attorneys, medical professionals, and accountants, you guys make way too much money. So we're going to put a limitation on your 20% QBI deduction. And here's the limitation. If you fit into any of these right here, then if you're a single filer and your taxable income is more than $232,000, that is including phase outs, IRS says, that's it. You don't get this deduction no matter what you do, okay? If your taxable income is over this. If you're married filing joint and your taxable income is more than $464,000, IRS says, no, you cannot do this. There is a strategy to go around that, and we're going to talk about that in a few minutes, but that is if you are an SSTB, okay? Now, let's say you are a business owner that is not an SSTB, which is not specified service trade or business. Regular business owner, I don't know, you provide some kind of a service, let's just say an online marketer, whatever that may be, and your income is above these thresholds. Do you get a 20% qualified business income tax deduction? The answer is 100% yes, but there is a but. Only if you have payroll in your business. Remember, if you're not an SSTB and you do not have any payroll, you do not get no 20% qualified business income tax deduction if you are above these two thresholds, single filers and married filers. Now, what happens is that a lot of business owners that are sole proprietors or single member LLCs, they make pretty well. Let's say a single filer makes more than $232,000. He has no payroll and not himself on a payroll. Guess what? You don't get a qualified business income tax deduction. Many times I've seen business owners that have an S corporation failed to take a reasonable compensation or any compensation at all, and they don't have any employees. They missed out big time on specified service trade or business. Now, what is the reason that you would miss out on a specified service trade? They missed out big time on qualified business income tax deduction. What is the reason that you would miss out on it? There's two reasons, right? Number one, your tax person did not properly check off the box to take the qualified business income tax deduction. The second thing is you have a tax preparer, not somebody who's advising you and kind of strategizing with you, like, hey, by the way, if you do a certain thing in your business this way, you can get extra qualified business income tax deduction. As a matter of fact, I just did it last week for a client. She sent over something to me. She's like, hey, how much can we take depreciation on this airplane that we purchased? I looked at it, I said, you know what? We don't need to depreciate the entire thing this year. And obviously, everybody has their own situation. I said, if we just do it this way, we're going to get an extra $40,000 in qualified business income tax deduction. That's a lot of money in deductions. So strategy is super, super important. Now that we have covered the basics, what is qualified business income tax deduction? Let's talk about two classic examples where qualified business income tax deduction is missed, is screwed over, and doesn't really happen. So I'm going to move over here. I'm still in the frame. Okay, perfect. Now, before we get those two classic examples, quick break. Hey, Boris Mashev here. Sorry for the quick interruption. 5 seconds, I promise. I want to make sure you get your free PDF, 7 write-offs every S corporation business owner must know. The link to this free PDF is in the description below. That's it. Thank you so much. Continue watching. Hey, all right, welcome back. So let's speak about Gary. So Gary is an agency owner. He is a pretty relatively new tax advisory client for our firm. He came to us and said, hey, my accountant is an advisor, but he doesn't advise me on squat. He's like, these are things that we did, And these are things that are going on. So I looked at his business return and I'm like, Gary, you made $2.1 million in net profit. He's like, yeah. I'm like, you're missing a qualified business income tax deduction. He was not an SSDB and he was over the threshold amounts, but he had a big payroll on the books that would help him get that deduction. Now, what was interesting about his case is that he has other businesses for which the qualified business income tax deduction was calculated, but not for the biggest business that he had. My conclusion was that his tax return was pushed off to someone to prepare the return, and it never went through the review process to catch this. It's literally just check the box deduction. Now, $2.1 million, 20% of that is $428,000 of missed qualified business income tax deduction. I think we got this number from the actual calculations that we did for him. Okay, his estimated savings $158,000. Now, can he amend his returns? Yes, you can go ahead and amend 3 years worth of returns to get back a qualified business income tax deduction. Simple as that. Now, this was missed every year. That's about $450,000. $450,000. I'm going to say it again. $450,000 in tax savings as this individual is going to be getting back a check from the IRS. This is a classic example where it was not reviewed, the box was not checked. What's interesting about this is that he actually had other qualified business income tax deductions on his return, but this was missed. The second classic example is that we had a Chris. He's a developer. His profit was $400,000. KMI, I reviewed the return. I'm like, you don't have a qualified business income tax deduction. He's like, oh man, yeah, my accountant qualified me as a consultant. Very quickly, we define his business. I'm like, dude, you're no consultant. Like, you missed out. And guess what? That's $80,000 in missed deductions, and his savings was $24,000. You don't even need to be a rocket scientist to do this, right? Everybody makes these mistakes, and that's why it's important that you work with proper professional on your tax strategy, on your tax advisory. Like I told you in my example, I was working with a client that is not over here. It's like, hey, we're buying this airplane. How should we structure this deduction? And I said, you know what? If we structure it a certain way when it comes to depreciation, because you actually have an option not to depreciate the whole thing, depreciate a portion of it. There's a whole thing. I did a video somewhere on YouTube about that. But what happened is that I was able to get her extra $40,000 in qualified business income tax deduction because I didn't want to bring down the profit too low and miss on the QBI, because we can always take the depreciation next year. So it was a great strategy we worked out. Why? Because that's what you need, ladies and gentlemen. You need somebody that will strategize with you and monitor your income, monitor your taxable income. And that brings me to our few of the tax strategies that are put together for you. But hey, right after the break. Hey, thank you so much for watching the video. Just want to take this quick break, first of all, to say thank you. Second of all, I really need your help. I want to be able to help other business owners just like yourself save money on taxes by catching my channel and really finding my channel. Now, YouTube's algorithms works in a way that if it sees a lot of engagement on this video or other videos, such as likes, comments, or even subscriptions, it really helps the algorithm push this video to more business owners just like yourself. So please go ahead, help the brother out. Appreciate it, and let's continue with the tax strategy. All right, awesome, cool. Let's get to it. Now, what are the tax strategies? Number one, first of all, review your prior year returns. Like I told you, take a look at line 13 of your personal income tax return. See if the qualified business income tax deduction was taken. Now, if it was taken and you have several businesses, check form, I think it was 8995 or 8895. I can't recall, but one of those forms on the tax return, it's an attachment to your return that lists each business that you're taking the qualified business income tax deduction. So first things first, check your prior tax returns. That is super and extremely important. The second thing is monitor your income. If you're an SSDB, if you're a specified service trade or business. What do I mean by monitor your income? Let's say you are reaching a taxable income of $464,000 if you're married, right? This is with phase outs. And you're like, oh man, if I'll bill my customer right now, and he's going to pay me right away. We're approaching year end, and he's going to pay me right away, and he's going to put me over this threshold account, this threshold amount, and I'm in an SSTB. Maybe I should wait until sending an invoice or billing for my services, especially if you're a cash basis taxpayer, which most of the small business owners are, right? Monitor your income, speak to your tax advisor about this. Damn, this is so important, ladies and gentlemen. This is your money we're talking about. Simple. This is a simple strategy. It doesn't even require rocket science. It's not a deferral. It's not something you have to give money to, okay? Another way you can monitor your income, like I've had situations with clients, I'm like, oh wow, they were like at like $500,000 taxable income before year end when we're doing projections. I'm like, you have some expenses you can just prepay right now so that we can bring you below the threshold and you can get your SSTB because we're monitoring your income. Oh, that was another strategy. That worked pretty well. If your accountant is ignoring your phone calls, ignoring your emails, doesn't get back to you, please drop him or her like it's hot. Get yourself a tax advisor. The other strategy is monitor your profit versus the taxable income. Now, when I wrote that, what did I mean by that? I thought we spoke about that, right? Monitor profit versus your taxable. Oh, yes, that was the airplane example. Oh, perfect. Man, I jumped way ahead, right? So monitor your profit versus your taxable income. What do I mean by that? When you bring down your taxable income way too low, you're gonna really lose out on the 20% because it's 20% times your taxable income. Sometimes you don't want to take a big deduction up front. This year, we had another case study with a client actually out in California, and they were just writing every vehicle off they were buying. They were really bringing it down to zero. They didn't need to bring down their income to zero by buying all of this. They needed to buy that, but they were really missing out on qualified business income tax deduction because depreciation can be carried forward. The qualified business income tax deduction, if you didn't use this year, you can carry it forward. So we did a very deep analysis of their return between their profit and taxable income, and now we have a strategy in place not to do a thing like that. So super important. Qualified business income tax deduction is a gift to you from the IRS. Now, we covered 3 tax strategies in this video. Now, let's kind of walk through it very quickly. First of all, review your prior year returns. Line 13 of your 1040 should show you whether your accountant, the tax preparer who puts the right numbers in the right boxes, claimed that deduction. Or monitor your income, especially if you're a specified service trader business. Before the year end, making projections. Should you prepay your expenses? Should you maybe not bill your customers for services so that cash can come in next year? Stay below the threshold so you can get that. Or monitor your profit between taxable income. Don't take all the deductions in the world right away if you don't need to. That's true. Deductions help you a lot with tax savings, but some of them you don't need to take it this year. You can take it next year to give you a higher qualified business income tax deduction. Thank you so much for watching my video. If you stayed this long, first of all, I appreciate you. Thank you. Please be sure to subscribe, like, or comment. Say something nice, hopefully. All right, till the next time.